Let's look at these three companies. Asian Paints, ROE of around 26% consistently for almost a decade. Tata Motors, ROE of 28% this year, one of its best in a long time. And Vodafone, where ROE, well, it doesn't even make sense because equity has almost vanished. Same metric, but three completely different meanings. And this is exactly why ROE or return on equity is one of the most misunderstood numbers in the stock market. A high ROE can signal a great business or a company taking dangerous risks. A low ROE can be weakness or simply a business in transition. So let's cut through the confusion and break down ROE with real companies and real numbers. Watch this video till the end to understand how to use ROE while analyzing stocks. But before we begin, this video is brought to you by the Angel One Research team. We are NISM-registered Research Analysts, and this is not investment advice. It's purely to help you understand businesses better so that you can make informed decisions. So, what is ROE? At its core, ROE answers one question. How much return is the company generating on the shareholders' money? Not revenue, not profit margin, but your capital and how efficiently the business grows it. Now let's say a company makes 10 lakh in sales and its cost of goods sold is around 6 lakh. In this case, it makes a gross profit of 4 lakh or a gross margin of 40%. After deducting all the expenses and taxes, what you're left with is a profit after tax or PAT of 2 lakh. That means a PAT margin of 20%. It's decent and sounds like a good margin. But what if you had invested 1 crore in this business? 1 crore in this case is your equity. A 20% PAT margin sounds great, but on a capital of 1 crore, this is just 2% return on equity. Great margins don't matter unless the return on your money is great. That's why competitive investors obsess about ROE. Now let's look at ROE from a different lens, capital efficiency. Let's say two friends start a business with 1 lakh each. Ram sells premium toys at 200 rupees, earns a 50% margin. He sells 1000 units, makes 1 lakh profit, which makes his ROE 100%. Shyam, on the other hand, has lower margins. He sells at 150 rupees, which makes his margin 33%. But he sells 3000 units and makes 1.5 lakh profit. So his ROE is 150%. Same capital, different strategy, different ROE. Even with a lower gross margin, Shyam generates higher ROE because he rotates his capital faster and uses it more efficiently. And here's another insight for you. ROE isn't just about how much profit you make. It's about how well you use the money you have. By the way, comment and tell me, do you usually check ROE while analyzing a stock, or is this the first time you're understanding it this way? So, how exactly to understand all of this? By just looking at the number. We need a simple but powerful framework that analysts use every day. The DuPont Analysis. Think of ROE as a final score. DuPont tells you how the score was created. It breaks ROE into three components. ROE is equal to profit margin into asset turnover into equity multiplier. Stay with me while I simplify this for you. Profit margin, which is out of every 100 rupee in sales, how many rupees becomes real profit. Asset turnover, how efficiently your assets create revenue. And equity multiplier, how much debt the company is using. This boosts ROE but also increases risks. So now, instead of just looking at a single number, that's ROE, you can actually tell, is this a high-quality business or a leveraged story waiting to crack? Let's make this simpler with a real example. Let's take two companies, Company A and Company B. For Company A, the sales are 100 rupees. The net profit is 10 rupees, which makes the net profit margin 10 divided by 100, which is 10%. Total assets 50 rupees. So the asset turnover is 100 divided by 50, which is 2. Now let's talk about the equity, which is 50. So the equity multiplier is equal to 50 divided by 50, which is 1. Now the DuPont ROE becomes 10% into 2 into 1, which is 20% ROE. Now let's look at Company B. It has the same sales, that is 100 rupees. Same net profit, that is 10 10 rupees, which makes the net profit margin 10%. The total assets here are 100 rupees. Equity here is 25 and debt is 75 rupees. So the equity multiplier is equal to 100 divided by 25, which is 4. Now let's talk about the asset turnover, which is 100 by 100, which is 1. So the DuPont ROE here becomes 10% into 1 into 4, which is 40%. On paper, you would say company B looks better, 40% ROE versus 20%. Same business margin, same 10 rupee profit. The only difference, it uses a lot more debt. If business slows down, company A can survive, company B still has to pay interest on that big loan. That's how a high ROE built on leverage can flip into a blow up. But analysts go a layer deeper and use 5-point DuPont analysis, where ROE is further split into 5 key performance drivers. ROE is equal to tax burden into interest burden into operating margin into asset turnover into equity multiplier. Together they show you exactly how much of a company's ROE is coming from operations and how much from financing or tax optimization. Now that we understand the mechanics, let's go back to our 3 companies and decode what ROE actually means for each. Let's start with the gold standard, Asian Paints. Asian Paints has delivered 26% ROE for almost 10 years straight. Not one lucky year, not a short-term spike, a decade of consistency. Asian Paint has a powerful distribution mode, unmatched brand recall, a dealer network that competitors struggle to break, and a business model where inventory moves fast and margins stay high. This combination allows it to keep generating high returns year after year, even without taking on excessive debt. But here's something interesting. Today the ROE is around 20%, slightly lower than its decade average. Why? Because a serious new competitor, Birla Opus, has entered the market. So the next few years will tell us whether Asian Paints defends its moat or begins to lose share. Now let's look at Tata Motors passenger vehicles. This year its ROE is 28%, one of the best in a long time. But zoom out, 10-year ROE 10.4% and 7-year ROE 9.34%. This tells you something very important. A single great year doesn't make a company a high ROE business. It just means the business is doing well right now. And the auto sector itself is capital intensive, cyclical, sensitive to commodity prices, exposed to supply chain shocks, and constantly disrupted by EV transitions. Take a recent example. A cyber attack at JLR halted operations, disrupted supply chains, and affected deliveries. Events like these instantly hit cash flows and therefore ROE. So yes, Tata Motors is improving. Yes, the company is executing well. But sustainable long-term high ROE? That's still an open question. This is what we call an average but improving ROE business. And finally, let's look at Vodafone India. It's the perfect real-world example of when ROE stops being a useful metric. ROE itself becomes meaningless. You cannot measure returns on equity when equity barely exists. The only real questions left are, will the company survive? Will there be more dilution? Can debt ever be repaid? Will equity holders get anything in the end? So these 3 companies teach us 3 different outcomes. Asian Paints, strong business, high ROE and consistent across cycles. Tata Motors, transitional business, high ROE in some years but inconsistent across cycles. And Vodafone, broken business, ROE doesn't even matter, and focus shifts to survival. This is why long-term investors don't look at ROE for 1 year. They look at ROE over 5, 7, 10 years to understand the real story. So the next time you see a company boasting high ROE, ask just one question. Where is this ROE coming from? If you want us to decode more such ratios, comment the next metric you want us to break down. And if you haven't watched our breakdown of the debt to equity ratio yet, go watch it here. And if today's breakdown gave you clarity, do like the video and subscribe. It truly helps us bring deeper, better research every week. See you in the next one. Sorry. Sorry. My bad. Got it.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.